Welcome, friends, and welcome back. It's Mackie. We're live. And today we've got a very, very special guest. You've probably heard of him. He's Ken Griffey Jr. Like he's got his hat on backwards there. That's an old reference for you Gen X fans. Now it's Eric Jackson, man. It's Eric Jackson of Opendoor fame, of cult of personality last year. He's a stock picker. He's an old friend. He's also the founder of EMJ Capital. He's doing a lot of cool stuff with AI. He's doing a lot of cool stuff with sentiment and analyzing all kinds of reports. We'll get into that real quick, but let's talk about kind of the why people have probably heard of you now. I've known you for a long time, first of all, Eric, and
Yeah,
welcome. It's great to see you. It's always good to see you, old friends. That was like, what, 12, 15 years ago we met? And then I was at Yahoo and you were buzzing
yeah,
around with them.
yeah.
It, it,
We first met like at some diner, I think just south of Central Park in New York before you made the move to California. But yeah, it's probably been 15 years. Crazy.
Jeez, man, time flies. Time absolutely flies. And so we were talking last summer, and it's about this open door thing. All of a sudden, you became famous. All of a sudden, you became like the man. Talk to me a little bit about how that speaks to the process of picking stocks. Because I'd never heard of it. We were talking about it kind of before it got buzzing. You were talking about this way of picking stocks, this rising dynasty idea. Talk to me about kind of the explosion in your notoriety and everything that went with it and how it ties into what your investing philosophy is, because you're an activist, you're a fundamentalist, you're doing all kinds of exciting stuff, and actually kind of an academic. It's your background is rich and varied.
Um, well, I guess for good or for ill, I've always had this hankering to want to find these like hidden gems, smaller tech companies that would just go crazy. And in the good markets, that kind of a process served me well. And in 21 and 22, I got my head handed to me. Didn't go so well when inflation hit, and all those kinds of companies like the upstarts of the world just got murdered. Yeah, I've tried to learn from my mistakes along the way. My wife would probably say I haven't done a great job of that. I think AI has definitely helped lately. So with Opendoor had been on my radar. Obviously, like Upstart, like a lot of these Kathy Wood type growth companies. I mean, there were a bunch of graves of all these companies after 22, and I guess I had the good fortune or smarts or good luck, whatever you want to say, of finding Carvana very early in its comeback. So Carvana had gone from like $400 in 21, early 21 probably, to as cheap as $3.50 in December of 22,
Yeah.
and then it came back, and I didn't. And I had traded it kind of, in the early days, like they IPO'd in like 16 or 17 or something like that. So I knew the company, and I was sort of monitoring it. But at the same time, like I built an AI system, and in May, so we're talking like 5 months off the lows, when the stock initially, when it was $11, I remember the first iteration of this AI model I built to try to, help make me a smarter investor and avoid the 21 and 22 kind of debacle. The first iteration of the first AI model that I built came back and said, you should make Carvana the number 2 long position in your book. And I was kind of like, what? And,
Now stop right there, because people go back in time. Like Carvana now is kind of a hot topic for a bunch of different reasons, and mostly because, oh God, it shouldn't be a 15 bagger. It shouldn't be. Back then it was left for dead. The stock we're
it
going
was
to talk
left for
about later was left for dead. So you built a system to try to help you avoid these type of things, and it comes back with one of these from the graveyard. That had to be a curious outcome.
it was left for dead, but it was also like everybody on FinTwit was dancing on its grave. So when it was down, if anybody talked about it at all, they were only talking about it like these guys are a bunch of criminals, because Ernie Garcia the second, the father of the third, is the CEO founder, did like a SNL crisis, like no settlement kind of thing with the SEC, like back in the 90s or something. But all these
Yeah.
like smart bears were like, they're a bunch of criminals, like having fun, like beating these guys into the ground. And there was nobody on the bullish side. Like there was no appetite back then in 23 to find the next Carvana. Nobody believed a comeback was even possible for a company that had gone from $400 to $3.50.
Just
So
this
yeah,
massive group thing. They buried everybody, right? Everything
yeah,
that was COVID associated kind of got chucked in the same grave, and just kind of that's where people thought of them, and everyone was dancing on their grave. The kind of sentiment that when everyone's on that side of the boat, eventually it doesn't take much to tip it over and kind of make it go the other way.
exactly. Yeah, exactly. And so, I dug in, and I thought that there was something here. I thought it was like the bear case was overdone. It was all about the debt, like the thing was going to go bankrupt because of their debt, but they were improving their unit economics and all this kind of stuff. Anyway, I took a week before, like the AI model flagged it at $11. I told the engineers, like, can you go back and like make sure that the AI model's not hallucinating? And a week later, they come back, no, it's good. You should do this. And by that time, it was $15. And so I took the position at 15. And I guess that's the other crazy thing here, Jeff, is like it probably never should have gotten to $3.50, but there was no evidence at $3.50, no financial evidence that the thing was going to come back from the grave. And everybody always likes to say, oh, you don't catch a falling knife and all that, just wait.
Sure,
I'm going to sit back. I'm going to wait for the evidence. Well, if you waited for the evidence on Carvana, it would have been like $65 before you got that evidence from $3.50. So anyway, I took a position. I was on CNBC like a couple of weeks later. By that time, like Carvana was up to like $21 or something. And I talked about it publicly. And you would think like if it was today and I did that, like everybody would be tweeting about it, talking about it. Back then there was like crickets. There was like nobody cared that Carvana had gone from $3.50 in 6 months to like whatever, $23 or something like that. They still didn't believe. I didn't hear.
It was a bounce they missed. It was a bounce
Yeah.
they missed. It was just 7 times off the lows, and screw that.
But it was also just like I didn't hear anything positive about Carvana until $300. And so to go to Opendoor though, when I had the good fortune, I guess, of being associated with that call. Mm-hmm. And so, last year after Liberation Day lows, like I got into Iron at $9. I got into Cypher, these like Bitcoin miners that were transitioning to AI infrastructure. I got into Cypher at $3. And so, like I noticed, like when I would talk about them and I would reference Carvana, there was like, oh, Carvana, I missed Carvana. Eric, what's the next Carvana? Do you have any in the next Carvana? And I did a podcast with our friend Josh Brown in mid-June 22, where I had said on his podcast, in the middle of this sort of downturn that was only like half done, I was like, well, like Josh said, what are you watching for like one of these stocks to come back from the grave? And I said, 1 was Carvana and 2 was Opendoor. And they were like, what? No way. Like those things are like death. Like who wants to touch those? And so obviously Carvana came back. And then, so I started to get questions last year. Like, hey, you mentioned on that podcast, you liked Opendoor. Do you ever look at Opendoor again? So I started to look at it again. And there was a lot that I didn't like. There was a lot of hair on that dog. And the CEO was terrible. And she was like selling constantly. She had these like 10b5-1 plans. It was like selling every 2 weeks she was selling. She sold at, the thing got down to like 51 cents. I think she sold shares at 56 cents on one of these automated plans. So
not a believer.
There was not a believer, but I could see like, oh, well, I didn't catch Carvana right at the bottom. Maybe, with Opendoor, maybe there's a chance here. It's going to take some work and it's going to be like more of an activist play. But, I got into it. And then when I started to, tweet about it, everybody wanted to talk about the next Carvana. So it's just like funny. I guess it's just like crowd mentality, maybe like now, oh, I missed Carvana. Now I got to, I want to find the next Carvana 2 years later, whatever it was.
And you pulled it pretty hard. You were unabashed about it. You took just a ton of heat for it. Had to be some moments of wondering yourself, and I mean, did that give birth to the rising dynasty moment? Tell me, tie those two together and tie together the idea of bringing in kind of the people as your activists and sort of not only taking them along for the ride, but sort of tapping into the energy and the focus. You get a ton of research out there online, a lot of it, just like a lot of these stocks that go from 100 to 2. for the
Right.
most part, there's a good reason. So there's a real process and methodology, and you got to be pretty sharp to find it. But talk to me how you went about empowering them, how you put up with the heat, and just sort of how this became its own separate thing. Because all of a sudden, my friend Eric is everywhere. We'd
Well,
been talking just months before, that was not the
yeah.
case, and then now you're a booming celebrity.
Well, yeah, and no, and as you know, like Jeff, I mean, I'd gone through this like career crisis in 21, 22. Like I had a huge investor like pull out at the end of 22. Like, so it was like, am I even going to continue with my hedge fund? How am I going to support my family? Obviously that creates a lot of family stress,
Sure.
and you're like, oh man, like I'm 50 years old and like I might have to like shut my fund down. Like, what am I even going to do with my life? Like, what am I even qualified to do? I've just been like sitting in my office with my dogs, like staring at computers, trying to like pick good stocks for like 10 years. Like,
And people start telling you about Ray Kroc. That's your personal bottom. When people start telling you Ray Kroc founded McDonald's at 52, it's like, oh man, oh boy, things are
right.
dark.
That's right. It's bad. Like when you can see the pity in their eyes and they start patting
Yeah.
on the back. Oh, yeah, sure. It's like, anyway. So I was going through all that, and I guess like coming through it, like it does, like whatever doesn't kill you makes you stronger. And so to deal with like some Yahoo on Twitter telling me I'm an idiot, it's pretty easy to like ignore that kind of stuff after that.
Sure.
And so, and it does give me, as you know, I dealt with like Marissa Mayer at Yahoo, and I never really questioned myself there that I was right and she was like a bozo CEO and just like needed to go. And so I guess if I hadn't gone through that experience, I probably wouldn't have been so cocksure that Carrie Wheeler, who was the former, she was the CFO who became CEO of Opendoor. I knew like she had to go. Like there wasn't even any question in my mind. And so I just like, any day that you waited like was a day wasted. And I remember like the old Yahoo board when I would like deal with them, like it was just constantly like stall, like just like say something to Eric just to make him shut up and go away and never come back.
So the real lesson there's less about Marissa or Carrie Wheeler, but like you knew the change that needed to happen. You knew a specific catalyst that you were looking for, and that was going to change the story. And once you saw that, then that was really kind of your trigger. It was go time.
Yeah, and I was fortunate because Opendoor, I mean, for whatever reason, people were interested in it. People knew it. People had some experience dealing with it, like in their lives. A lot of people had good experiences with it pre-2020, I would say. And there was also some founders, like Keith Raboy, was like wrote the original business plan for it. He had been on the board. He left in a huff. And he has like some, tech pixie dust attached to him. So he became supportive of me, like this guy, shouting in the wilderness on the outside. And that helped for sure. So anyway, all these things came together and it worked out. But I definitely noticed like there was a big retail component in terms of the people that were piling into Opendoor, getting into it, like communicating with me. And I think they appreciated that I was, basically on their side. I was trying to like coach them, give them advice. Like I remember people would tweet me when the stock, I got in at 73 cents, right? The low had been 51 cents in June. I got in at 73 cents. And then when I first tweeted about it in July of last year, it was like 87, 88 cents. And so then the stock, it didn't react the first day. And then over the next few days, it starts to build. And then like, I don't know, 10 days later, it hit like $5 and pulled back. But I remember when it was like $1.50, I remember somebody tweeting at me, "Oh, that was a good idea, Eric, but I missed it. Sorry. Tell me when you get your next 100 bagger." And I'm like, man, like my price target was $82. I mean, it's $1.50 and you think you missed it. Like, so, trying to like coach people like on how to kind of avoid those kind of cognitive, biases that we all have.
Sure, you get sunk into it, and if you're an activist, you're taking a siege mentality. You're digging in, and you're waiting for this catalyst. You're trying to make it happen. You're trying to force it, push it, prod it, whatever you can. sort of say you missed it. It's like, well, if I was in it for 40 cents, that this would have been a huge waste of my siege energy. Like
Right.
these are long-term projects
And
they're
then,
looking at.
but there were so many people, and they were all around the world, Jeff. That was the thing. Like Opendoor is only in the U.S., but I was getting emails from like people in like Mongolia and Saudi Arabia, and like, I wish Opendoor could come here. And everybody was sort of complaining about a bunch of things. They were complaining about the cost of living, so everyone's feeling pinched everywhere. Everyone, is sort of bitching about the price of housing. And finding it hard to get ahead, and especially young people. And I was getting a lot of emails from people saying, hey, I'm a plumber, I'm a painter, but I study stocks for like 3 hours a night. And I see like, I'm not going to change my family's position in life through like playing DraftKings. I have to like make some money in the stock market. So
Right.
like that's where the idea of like, hey, like we're all in this together, we're all trying to improve our families' lot in life. And like that's sort of like the idea behind like Rising Dynasty, and it had to. I felt like it had, it was going to be more than just Opendoor. Like Opendoor is a great company. I still believe in it. I still own it. I still believe in Kaz, the CEO there. I believe it. People say, oh, you don't never tweet about it. Like, oh, you don't think it's going to $82? No, I still own it. Like, what's there to tweet about? The guy who should be in charge is in charge. I mean, let him execute. Like, what am I going to tweet about today? So, but I just think like there are more opportunities out there, more stocks. And I wanted this sort of to be a bigger movement than just about Opendoor.
So that became a movement. You're kind of an ideaphoric type of guy. You have high energy. You moved on with it. You've developed this tonality. That was, I saw that over the last few months. Tell me how this is working. Tell me what the idea is. I'm a conference call guy. I read the vibes of the analysts, or the CEOs. I think that's actually just invaluable. You're kind of automating this, and you're figuring out how you're applying AI and putting your PhD to work, and sort of able to go through. You're culling thousands of conference calls where it takes me 3 hours to listen to Gary Friedman at RH. Your system seems more efficient than mine. Tell me how you're going about doing this, and then we'll get to your latest idea, or not your latest, your second to most recent idea. That's a stock I'm familiar with.
Sure. So I launched a site a couple of months ago because I was like using Claude Code like a madman for the last 3 months, sort of experimenting with it. And I wanted to create this website, Event Horizon IQ is what it's called, where it's supposed to be like a clearinghouse for cross asset, like market indicators, like one sort of like Fred is okay, but more up to date, like more information, hopefully more unusual information in one spot. And so as a part of that, I was thinking like, hey, like I believe like you, like there's a lot that comes across in these earnings calls, but these CEOs, I mean, they're coached by like dozens of people, especially at the bigger companies, on what to say and how to say it. And the prepared remarks are obviously written by, somebody else rather than them. But I felt like, especially in the Q&A sessions, like that's when the guard comes down, right? And that's when you can probably get a few glimpses at like who's really running this company. And it's not just the CEO. It could be something you notice between the differences between what the CEO says and the CFO says. Like maybe there are things like if they're far apart in how they talk about the business, that's interesting. If they're aligned, that could be interesting. And so
normally you have to really know the management. I mean, I listen to the Nike calls, and I'm always putting the over under on when they go to Q&A. Because whenever Nike's about to warn, it takes about 45 minutes before they get to the Q&A. And then, we're out of time. We don't have any more time for the analyst here. We've spent all our time talking about Serena Williams. And
that's right.
The glorious comeback that we have.
As soon as 59 minutes comes along, okay, that's all the time we have for today. So thanks very much. We'll see you next quarter.
And so through tonality, you're setting up a system where you can kind of automate that. It's like a forensic analysis type of thing. I mean, you're really like a lawyer, like a cross-examiner or something.
Yeah, like what I set out to build was like something that's sort of a deeper, like trying to understand what's the linguistic pattern here, like how much conviction do they speak with versus how much constraint, how much hedging language do they use versus how much sort of bragging language. Are there markers of hubris, that are maybe a warning sign? And so like it goes beyond like there are people out there that do the like keyword analysis on earnings calls or sentiment analysis or neuro-linguistic programming analysis or something. I think they're pretty simplistic and stupid and not informative. So I wanted to kind of build something deeper. So I basically took all these like earnings calls. I got 173,000, fed them into Claude Code, asked Claude Code, so across 4,600 public companies, and asked the Claude Code to kind of look for the deeper kind of patterns that might exist, that kind of could characterize like the tells, and to kind of differentiate between prepared remarks versus Q&A statements, and the differences between the CEO and the CFO, and also even to the point where you can actually study the audio of the calls, and kind of do people speak low energy, high energy, more guarded, all this kind of stuff. Anyway, threw it in the mix, did the analysis, and came back with like 20 different patterns that exist in across companies.
And what was the point of the patterns? The patterns were that they were tells before, like they would indicate they would correlate with future performance in terms of financials turning around, in terms of something going on in the company that's investable. The idea wasn't just to bust these people telling fibs. The idea was that they speak a certain way when they know more about the company than anyone, when they're actually seeing a turn in the business, versus when they just are saying so because IR wants them to and they're trying to keep the board happy.
Yeah, and I'll give you one, for instance, is like Apple's probably the most buttoned down company, that I know of, like in terms of controlled, PR, restricting IR, restricting everything. Tim Cook, like, very monotone, doesn't give up much on those calls. And do you remember a couple of years ago, Apple was sort of hinting that like they were on the verge of like an AI breakthrough, like the Siri was going to be amazing, and it was all kind of leading to June. A developer conference keynote that they were going to have, and the stock sort of ran up into this, and then nothing happened at that keynote. Nothing was announced, and everyone was like, "Oh, that's
didn't come together."
Kind of weird. And then a couple of months later, suddenly the head of AI is fired or retired or whatever, And so, what was interesting is that this tonality IQ picked up that in the quarters leading up to June. If you went back like the 3 quarters before, Tim Cook definitely was like is like one of the most reserved, CEOs in the data set. And yet you could notice that his confidence level was rising leading into that. So he was giving off tells or signals that he was more confident than typical. And so that sort of fed into the stock price running up. But then 1 quarter before June, like there was like a big drop in sort of this confidence level. So that was the tell that there's something was amiss within this company. And then it did play out that way. And then they had to go through this whole thing. So like that's like sort of one example. I would say like a couple of other patterns that are also present. I think this has been the case with RH, but not just RH, like a lot of companies, like a lot of times when things are going well, the hubris rises, not surprisingly, right, with these CEOs.
Right.
And so if you can measure like the ratio of the confidence or conviction level versus the constraint type of language on the calls, and if you notice that's really ticking up, that's a warning sign.
And I noticed something in the RH call that Matt McClintock did as well. You flagged on it. I listen to those calls every once in a while just because Gary's kind of bonkers, for good or bad. He's a very good merchant, a little crazy, which is something all really good merchants have in common. But in this call, which was a particularly bonkers call, he released it on video, but it was more indicative of a bottom. He didn't change the numbers. He normally is quite liberal with kind of fudging the numbers, coming up with new metrics. Oh, we've got this demand thing that comes up. That's generally speaking a sign to bet against that company. He, while issuing a terrible numbers anyway, a terrible kind of outlook, was exhibiting signs that are more typical with kind of an RH bottom. With you see more often at the bottoms for the stock, despite the news just being horrible. I mean, what'd you find? What'd you saw? I noticed that because Matt saw it. He's a fundamental guy like me. We both kind of noticed this is goofy, but it's not as bad as it. This is typically more associated with kind of a turn in the company.
Yes, I agree. I'm not a retail guy like you, so I don't usually fish in the RH pond. But I did, follow that call, and I did run it through the tonality, and it did come back and say, yes, this is sort of like one of the most constrained. I think it might be the most constrained earnings call that Gary has ever exhibited in whatever, that data set. And that was bullish for RH according to this. So we'll find out over the coming quarters.
We'll see. It's a crazy contrarian call, but it was this subtle nuance that you wouldn't necessarily notice. Now, speaking of fishing in pools, and this brings us to something I saw from March 29th. Pull up slide 5, guys, or March 27th. Long Peloton at 4. Now, I am infamously kind of a fan of the company. I'm about 4,500 rides into it since April of 2020, since I bought it. Rode it up to the COVID highs. Have been trying to pick away at it at the long side just because I don't think they go out of business. But finding a bottom has been pretty elusive. They've been in the graveyard for about 5 hours. It is, notoriously, despite 2 million plus subscribers that really don't churn unless Peloton is offensively bad management, which they've gone through phases of that. But they're on their third CEO now. The latest group seems much more rational. There's a lot of kind of activities that are, initiatives that should work, haven't worked over the long course. But you like these guys. No one likes these guys to the point that not even I am trying to pick away at the long side. And all of a sudden you're on board. The what gives you this confidence? And tell me about, let's put the pieces together in terms of how your previous work kind of went into getting long this extraordinary physical fitness machine that no one likes except I guess me and you.
Yeah, no, I mean, there are fans. I heard about them from them. Like after I tweeted this tweet thread out, I mean, it was like my Opendoor tweet originally got from July, like through today has something like 600,000 impressions. And this tweet in the first day got like over 1 million impressions or something like that, or first day and a half or something like that. So to me, it tells me like there's just like Opendoor, like there were a lot of, who can say like why some of these companies like have this sort of like emotional attachment with people, but it did for Opendoor. And I
did a ride yesterday for my birthday because I ride every day is like a psycho on my birthday, with 2,000 people. 2,000 people who are subscribers to it. It's a random ride based in England. I'll go on German EDM rides just because I like the rhythm of the music. There's another 1,000 people on there. The subscribers are famously loyal. A lot of them pay $45 without even ever using the bike just because it's in their basement. But, they gather your metrics. They get a lot of things, a lot of commonalities with like the Stravas of the world, where the stickiness comes from the fact that these guys know what my heart rate should be at various wattages for the last 6 years. I'm not going to transfer that someplace else or change it unless they really force me to. That's one thing. The company's priced like it's going out of business and just continues to, no matter kind of what they do, it's priced like it's never going to turn around, can't possibly turn around. And tell me what, like, just put the fundamentals together with the sentiment that is about as bearish as can be, and tell me how you come up with like it's a buy here at 4.
I think it's priced like it is going out of business. And I don't think it is. I mean, like you say, it's got these 2 million or whatever it is subscribers that aren't churning. I think right now for this next quarter, they'll report in early May, the consensus is that the churn is going to be 1.3%. I mean, that's nothing. And these guys are all paying like me, like, I don't know, $50. I don't even know what I'm paying every month. And so the free cash flow is like 345 million in the last 12 months. It's been getting better. They're going to be profitable soon. Jim Chanos attacked that tweet a couple of days after I tweeted it, saying, some of that free cash flow is from stock-based comp. Yeah, okay, fine, but like everyone does that. But minus that out, they're still free cash flow positive and growing. And he was like, oh, and they have net debt. I'm like, yeah, what does it matter if you're free cash flow positive and you can pay it off in the next year? And so anyway, it's people like it. They have a bunch of growth vectors, like new product opportunities that they're launching, like corporate wellness, which I don't know. It's apparently 10 times the size of Peloton's core market. I don't know about that, but I do know that Peloton has a brand. And if anybody's going to do something, it's not, I probably am more likely if I'm, working at a company to sign up for a corporate wellness account with Peloton versus, I don't know, some Whoop or whatever,
I mean, they've got the institutional side of it. They've got Precor that is kind of the equipment that you see in the vast majority of gyms. They've done absolutely nothing with that. There's no integration whatsoever. They paid $420 million for it under Foley. Ooh, that was not a good idea.
Last dumb acquisition right before they like drove off the cliff. But you're right. Like they want to get into the gyms right now, right? They want to have Pelotons and Equinox. And so how do they do that? Well, Precor could be a little helpful there. Hey, you want some new Precor? You want a discount on your Precor equipment in your gym? Like put some Pelotons in there. So I think that is an asset for sure going forward. They have something called Peloton IQ they're launching. Apparently they're going to charge you more to give you AI insights about all your workouts. But, like you say, they've got all that information anyway. And they have this new CEO, Peter Stern, who's on the job. He's only done 2 quarterly calls so far. But again, when I analyzed the difference between Foley versus McCarthy and now Stern, like huge difference from a tonality perspective. Foley out to lunch, kind of like pie in the sky, not.
He was a little over his skis intellectually, I would say, to be
McCarthy.
Nice.
Everybody loved McCarthy at first. He's gonna be the next Netflix, maybe. The problem with McCarthy, he could only see like in front of him and talk about cost cuts. He never talked about vision, product roadmap, how to, generate some growth. It was just cut. And so Stern is, even though it's early, it's only been 2 calls. The tonality results were positive with him. So realistic, kind of feet on the ground, unlike Foley, but speaking about vision and kind of where he wanted to take the company, but speaking in a very positive, like we will get there kind of language, as opposed to, I don't know, overly negative, which I think McCarthy was. So, I mean, those are all pluses. Price just too cheap. Hey, we're going to have Aura and Whoop probably IPO later this year, and they might, they're right now they're trading at something like 8 times revenues. I've heard some people say Aura might come out at 20 times revenues. Now, I don't think that's right, but I do think there's a huge mismatch between, if they're worth anything close to that, like Peloton's worth a heck of a lot more than $4 a share.
What's your vibe on Stern in terms of taking care of it? It's because they've had this data, they've had these opportunities for a long time. Back when they had cash, they were burning R&D like crazy, and they somehow managed to come out with absolutely nothing in terms of new products, and really an astonishing effort. And so the stock is kind of fish hooking here. It's doing nice things. The report in May 8th? They report actually in 1 month. 1 month from today, give or take.
Yeah.
What are you looking for in that quarter that'll give you more confidence that this is going to be the team that can kind of not, if just stop the bleeding? I mean, the last rollout, I think it's probably McCarthy. It's the legacy of him, his last legacy. But they tried to come out with new bikes. The new bikes were uninspiring. They raised prices at the same time, which is really on Stern. That kind of bumped churn up a little bit. Churn, I think that was really the death. Now that took the last 50% out of the stock, because the story there has been churn has been so low. Any upturn tick in churn was a problem. Is that going to be what your tell is on May 8th, or what are you looking for to see some signs?
They did a price hike at the end of last year, and so that did spike churn, like in November, December, and into kind of the beginning of January. But I do think that should show that it's settled down now. So they also had a miss last quarter, which caused the sell-off in the stock and EBITDA. I don't think they handled that properly in terms of like a communication perspective. So there's been some growing pains with this new CEO. I mean, they have to not screw up, obviously. Report good numbers, beat, show low churn. I would like to see. The one thing that I don't think the market is appreciating is that they've already indicated in some of their filings that they previously had. They're also getting, from terms of the Foley era, they had a lot of like financial hiccups and financings that they were having to kind of unwind. And so there's going to be about, I think it's like 700 million in cash on their balance sheet that's going to be unlocked at the end of May into June that they can choose to do stuff with. where they couldn't before, because if they did and they touched it, they'd have to pay a penalty for touching
And
it.
they haven't been let out of that. I think that's where the you and Chano's dispute was. I don't have Jim on the line with us, but I suspect that was where the rub was. That the Peloton has this kind of debt hanging out there, and their counter has been they're going to be able to pay that down. They actually have cash and they've got debt.
Yeah.
But they haven't taken care of one with the other because it simply paying penalties in advance. So that comes up later this year, right?
But it's already been disclosed in a prior filing that unlock happens at the end of May, I think it is, and so they're going to have like $700 million of their cash. That's sort of they could do a buyback with, or they could reduce debt with, or a combination of the both. So I think that's probably going to happen. They haven't indicated what they're going to do, but that's the timing of when they could do something. So for me, like, it's not, again, like, to go back to the Carvana thing, everybody was like, oh, why should I get in now? Peloton's been a loser for years. Why now, Eric? And so you never are really going to, you're never going to be able to say, oh, everything, the stars are lining up here. I mean, there is a bit of a leap of faith here involved, but I do think there are some specific things that are going to get announced, and the likelihood is their churn's going to be low. They could announce a stock buyback. You could have this Aura and Whoop kind of external data point out there that sort of makes people say, "What? Why the heck are we valuing Peloton like this?" So I think like the biggest product opportunity they also have, Jeff, is like in the tread at the low end price point. They have a $6,000 tread. They have I think it's like 3,500. They don't really have anything in the 2,000 range, and that's the majority of the tread market in the U.S.
So and the tread market dwarfs the bike market. And another thing that it's like, how many CEOs do you have to go through before someone points out that maybe we could make one for $1,200 and sell a lot of these? And that would be an idea, a thought, a notion.
I mean, they could do other things. Like, I was talking to one investor the other day. He said, like, if they have like multiple people in the same household, like one's working out on a bike, one's doing stuff, I don't know, Pilates or something, like, maybe they should charge more. It shouldn't just be like $50. So maybe there's some like ways that it's kind of like a Netflix idea of like charging for like multiple members or something. Anyway, I mean, but I do think there are some levers they can pull, and it's just too cheap and
gloriously easy to crap on. I mean, it's just gloriously easy to say. They're nothing but clothes hangers. They're never going back to COVID. Both those things are true, and they still are cash flow positive, and they still have loyal subscribers who aren't going anywhere because they hold their data hostage.
People love the instructors. My wife loves one of the instructors, and like, as long as she's there, like, she will never cancel her.
Which instructor? Who does she ride with? I know all.
Olivia Amato.
Oh, geez, because the hardest ride's on there. Your wife, hats off, man, because Olivia is terrifying. I mean, you consider me the Lance Armstrong of Peloton. I am. But all modesty aside, Olivia's great.
But it's not. It's like half for the workout, but half for the motivation. So it's a 2-in-1.
Yeah. It's just, and they become kind of your fitness buddies. I mean, it's a super sticky application. It's a great ride. And again, they keep your data. There's a lot of stuff that they can do. If you have everyone's health data for an extended amount of time, there are applications from insurance to AI that they just haven't taken advantage of. I mean, they should be offering me much more sophisticated workouts than what they do. And so they haven't really even scratched the surface. Interesting story. Anyway, man, I'll let you go. Thank you so much for your time. He's Eric Jackson. He's an interesting guy. He's thinking about stuff in a creative way. He's a longtime friend, and it's worth kind of checking his ideas out and seeing this stuff. Where can people find you, and where's the best way to get your fresh thoughts?
At Eric Jackson on X, and I have a new Substack that I'm posting to kind of regularly. It's eventhorizoniq.substack.com. It's for free. There's a paid tier, but it's free. Most of the stuff is free on there. So if you want to read the long form stuff, it's usually up there.
All right, buddy. And what's your Peloton handle?
I think it's Eric M. Jackson on Peloton, because Eric Jackson I was too late to the game.
All right. I'm Fomighty. We'll get together. We'll live ride, and we'll talk very soon. Thanks so much for your time, man, and thank you everyone for tuning in. We will see you on Mackie Live next week in this very space.